Thank you, Ron and Heidi. We are in a time of growth and change, and our financial health is in peril if we don't understand the impacts of debt, borrowing, and reinvestments. The presenters discussing these critical areas today are Andy Laufer, Managing Partner of Laufer LLP, and the recent President of NAFCA. All who know and who have worked with Andrew have experienced firsthand his high level of energy and enthusiasm to bring his role as an accountant, strategic business advisor, and corporate advocate for McDonald's operators and next generation candidates. Along with Barbara Runzer, who is a partner with Bodine, Perry, Robinson CPAs, based in Columbus, Ohio, office, and is honored to begin her 25th year working closely with McDonald's owner-operators to help them achieve their financial goals.
Good morning, everybody. You guys really know how to throw a party. You have such a great meeting. I love how organized you guys are, and it's such a privilege to be able to be here and have a dialogue with you. It's also great to be with the NFCA firms. You know, most accountants, everybody looks at them as, hello, good morning, I'm really happy to be here, and then bam, your heads go down. That's not what we're about. That's not what NFCA is about. We not only possess the knowledge, but we possess the passion for you and this McDonald's business.
Absolutely, I couldn't agree more. Andy and I are going to be discussing a critically important topic to everybody in the room today, not to mention a timely topic in light of the recent developments involving reinvestments and financing decisions. When Andy and I were talking about our presentation, we kept coming back to one critical point, the importance of planning. So when I think of planning, a famous quote comes to mind by Benjamin Franklin: "If you fail to plan, you're planning to fail." So
anyone that knows me, I love quotes. And a couple years ago in reading, I came across this new quote, and I got to read it. So planning is bringing the future into the present so that you can do something about it now. So there's two key words there: planning and now. And it's just so critical, whether it's tax planning, whether it's planning how you're going to sell your business. As you learned, you have an objective, you have a goal. If you don't have a well thought out plan, all you're doing is hoping and wishing, potentially even really dreaming. We want to make sure that you understand, with effective planning, those hopes, wishes, and dreams, they're going to become reality.
So in order to do that, we put together the top 10 items we consider when helping our clients make financing and reinvestment decisions. The first thing I always discuss with my clients is their current economic position. So it's critical to assess that you're meeting McDonald's financial viability standards, which I'm sure you're all familiar with. And however, that's not the only gauge you should consider, because just because you're currently meeting them does not mean that you'll maintain financial health going forward. The items that make that up just change very frequently, so that those things can change by month, if not by year. So a number of factors need to be considered, one very important being your current debt.
So debt. We all love debt, right? Everyone just wants more and more, as much as you can get, right? Can't wait to get out of debt. But that's a tool. Let's think about it, right? It's a tool that helps us to be able to reinvest in our business, to help us grow. Many of you in this room have likely or should have been investing in your restaurants. You might have bought restaurants in 12, 13, 14. You might have done a full wall rebuild. You might have done a knockdown, drag out, rebuild. All before BBV was announced. So what happens? You're economically viable. You're above 1.2 cash flow coverage. You're in great shape. And then all of a sudden BBV 2020 comes. You actually love the program. You think it's really great. You can't wait to modernize your restaurants. You love the movement towards, healthier products. But you sit with your accountant and you go, oh, but if I take that debt on, I'm going to be at a I'm going to be at a 0.9. I can't do that. So you're economically in trouble. So what do? Well, one, you either don't do the project, but you really, really want to do the project. So how do you go about doing that? So understanding your debt becomes critically important. But that means not only understanding how much debt you have, but when your debt is going to be maturing and what your interest rates are. And that gives you the opportunity to plan, speaking with your CPA and speaking with your banker and looking what your options are. By show of hands, how many people have either done or know what a weighted average refinance is? Come on, exercise. Somebody help me at least. All right, so some of you do know. So weighted average refinance is a good tool. What does it do? You have debt that's coming off in 2020, 21. Maybe you have a big note. Maybe it's $100,000 a month. And some of you in this room, I'm sure, have debt that large. Well, when it falls off, you feel like you're going to have a victory. So what do? Well, if you take the new debt that you're going to bring on, which is either 7 or potentially 10-year debt, by taking a mathematical formula of weighting the amount you owe and the maturity date, you blend it into one new loan. Therefore, instead of having this large debt and then another debt piled on, you end up with one new loan. It's a tool. It's not the right tool for everybody, but it's something that I find many people don't know is out there. And you absolutely should know this is out there because it can be beneficial for you. Another great tool is, look at my notes here. Look at that. I froze. That's very unusual. Stepped amortization. And why did I freeze? I don't know. I love stepped amortization. What is stepped amortization? So stepped amortization basically says, I got this loan. It's coming due in 2020 or 21. It's like a birthday present to me. I want this gone. I don't want this thing to extend a bunch of years. And you know what? I'm with you. I'm 100% with you. But you know you got to do the project. So what do? You go to your bank and you plan with your CPA and you have a dialogue about, hey, how do I make this work? I can take some debt on. So what do? You keep your existing debt. Your interest rate is probably better on that, so you don't want to give that up. And now you take the new debt and you have stepped increases. So instead of a level payment in principal or mortgage style amortization over 7 or 10 years, you borrow this money, and then when some of your debt falls off, the new debt ramps up, and it might ramp up in steps. So in 2020, your loan amount might increase, and in 22 or 23, again, it might increase, but you retire the debt within the 7 or 10 year, period. That is an underutilized, tool. It's not what we're all hoping to be able to do, but again, it gives you the ability to stay economically viable, and maybe you'll sleep a little at night. You probably get 2 or 3 hours. Maybe this will give you, 3.5 hours of sleep because there's no stress in this business, right?
So another component when looking at your debt is to determine your borrowing capacity. So you might have a strong equity position, but if you add new debt, whether it's acquisition debt or reinvestment debt to your existing debt, that could cause your cash flow coverage ratios to fall below the standards. And another thing to keep in mind is the bank may have different standards. So just because you're meeting McDonald's viability standards does not mean that you are potentially meeting like your loan covenants for cash flow coverage ratios. So just make sure that you're aware of the bank standards as well as McDonald's standards.
So Barb, now that they, understand their borrowing capacity and what their options are, when you're talking with your clients, what's next? Like, where do you go? What do you do?
The next thing I would do for the planning is that you must list out all your BBV 2020 projects and all your required reinvestments. So make the list, but it's also really critical for you to develop a preferred timeline for the projects, when they're going to start, what your downtime is going to be, and that's critical by project. So you need to do that. That timeline might change. Obviously, when your projects start, it might change, but that's a really good place to start. So you need to develop the preferred timeline for all the projects. And once you do that, then you can prepare your projections.
So Barb, the big thing, and I'm doing great with the clicker. You see the wrong guys got it. When you finished your timeline, the one thing that I find frequently happens is that everybody knows when the register stops, the cash flow stops. So when you're doing your planning, you go, okay, I get $20,000 a month from that restaurant. I'm going to be down for 3 months. I'm going to lose $60,000. That's somewhat accurate. The one thing that you critically must understand is that certain costs will not stop. Okay, you might have key employees, managers, or key crew people that you just can't, put out on unemployment. So what do? You'll likely move them into your office. You'll likely move them over into another restaurant. Therefore, your labor is going to be higher. So make sure that you take into account costs such as that. Insurance doesn't stop. You're going to have to carry that. Your real estate taxes, the government doesn't tell you, don't worry, you're not conducting business. Those costs don't stop. depending upon whether it's a complete knockdown, if it's a full wall or a modernization program, you're going to have utility costs. So please make sure that you go through that. But the one big thing that I find is forgotten so often, and it also happens upon a sale. The people working for you today don't get paid today. They don't even get paid tomorrow. They get paid next week. The sales tax you collected today, yesterday, and every day this month doesn't get paid this month. It gets paid next month. The McDonald's rents, your service fees, your advertising, they don't get paid this month. They get paid next month. You need to make sure you understand that you're going to need, you can call it a pile, you can call it a reserve, I call it part of your working capital, but you must make sure that you account for the cash you need from the time that the cash register stops ringing so you can still run an economically viable business as you're going through these projects. And if you have multiple projects, it becomes even more critical that you account for that time when you've been living on, the float. The float is absolutely fantastic. But when the register stops and you have to have that money, you got to make sure that you have that money.
So in order to account for all the costs, you also need to prepare both individual restaurant cash flow projections and organizational level cash flow projections. And you really need to do them for at least 3 years. I think that's really critical. Things change every year, so you really can't just look at your current situation. You really have to go out at least 3, maybe even 4 or 5 years. So you need to take into account all these costs we're talking about when you're down, the potential sales and cash flow growth, and all the depreciation that everybody's been talking to, because that's going to change your cash flow every year, and that is also going to affect all your income tax liabilities. So it's really important to do multi-year cash flow projections.
So Barb, when you're doing your projections, do you find that everyone's excited to talk about the tax consequences?
Absolutely. People love taxes.
It's the most exciting topic.
Yeah.
You guys did a great job.
Please let me just pay the most
The room was
taxes I
elevated.
can.
Everyone was really happy. But the tax planning portion, and Ron, covered, one of the most important components, which was depreciation. You must, in any effective multi-year plan, look at the tax consequences. Without doing that, you're making a tragic mistake. Many people that I speak to will come up and say, oh, my accountant is awesome. I paid no tax last year. And I look at them and I go, oh, okay. Or I got this huge refund. Oh, okay. It's like, what are you telling me? That's probably not the right answer. Paying no tax is not the right answer. There are various tax brackets that you want to manage within. Why not take advantage of a very, very low tax bracket? Because once you've utilized that bracket or haven't utilized it, it's gone. If you have no income, you're never going to get to take advantage of the lower brackets. More importantly, as you take the enhanced Section 179 or the bonus depreciation, you can have very little or no tax in years 1, 2, 3, and say you opt out. And now you spread it out over 5 years. But if you have debt that's going for 7, you're going to have a mismatch of actual cash flow and actual book profit. And if you have 10-year financing, you're going to have your 6, 7, 8, 9, 10. You can be under severe economic duress because you're going to look like you're making a lot of money on paper, but with no depreciation, your tax bill can be very high. Again, the key component is planning and understanding the impacts so you can make sure you maximize the tax benefits and reserve cash, for future obligations.
Another thing, too, that if you were just looking at that current year, I'm sure a lot of you did the DLOCs, the development line of credits, and that's the same thing. You did 12 months interest only, so now month 13 comes along, you've got a giant principal payment, but you don't have any depreciation to go against it. So that's kind of along those same lines. And another thing to remember is your return on investment. So you really want to consider that by project. So you want to consider which project would yield the quickest return on your reinvestment in your planning process. So we're all in this business to make money, so you should expect a decent return on your investment.
Made it to the end, like for you David Letterman fans, a top 10, and neither of us fell off the stage or really did too badly. That's actually pretty good. But one of the other important things to consider, through this is, what are your future plans? We are in a time, and Barb, I got to ask you, you've been doing this for 25 years. Have you seen, a time where more people are approaching you about either wanting to sell or, even, buying? What are you seeing?
No, it's unbelievable. I mean, like the amount of valuations, buying, selling, people retiring, obviously. But I mean, yeah, no, I haven't seen anything like it, that it's like it's been for the last couple of years.
Right. So when you consider that, so say it's on your horizon to buy. You have a lot of cash on your balance sheet. You're economically strong. You have all of these projects to do. Well, what's the smart thing? Do you use your cash and pay for the projects? That might be the right answer. But there's a 10-store package that you think is going to be available. Might be at a little bit, of a premium, but geographically it fits in. It fits within the profile of the restaurants that you want to buy. You make a deal, McDonald's is blessed, they're happy with you being able to buy it. But then you get, it's a little tight, we'd like you to put some skin, in the game. Or the bank looks at it and says, the underwriters love you, but they want you to put some, money in, and you're like, but I'm great, my ratios are great, I got a 1.6 cash flow coverage, my balance sheet is strong. They go, we know, but this is a standalone, doesn't work. We're seeing things like that happening nowadays. So with that said, it might make more sense to hold some of those bullets. It might also make some sense to pull some of those bullets out of the business, keeping your balance sheet economically strong, making sure that you're not meeting the 1.2, because remember, the 1.2 is a minimum. That's not the target. That's not the goal. The goal is to be above, 1.2. But that doesn't mean that you got to be at 1.5 or 1.6. You can pull some of that cash out, put it aside, put it in your name, make it dry powder. And therefore, if you have an opportunity to buy and you need to inject capital back, you will have the resources to be able to do that, and your banks will feel, more comfortable. So again, the emphasis is not that that's going to happen. You're trying to give yourself an opportunity. Another thing, that you'll always want to, consider is that if you're going to be selling, right? We hear this frequently now. Andy, it's time. But I can't get what I want from my restaurants because of the reinvestments. So we talk about that. And one of the things they say is, I'm going to stick in for 3 years. I'm going to borrow the money. I'm going to pay some of the debt down. I want to get some of the benefits. If I'm going to spend this $1 million or $2 million, I want to get something back. I want to feel the victory of cash flow growth and the escalation. That's probably smart in many, many, instances. But in that instance, you also have to have a conversation with your banker and with your CPA and plan on the type of debt. Today, we're seeing a gap between fixed rate and variable rate debt very small. And while, none of us have the crystal ball, and if any of you do, please, I'll pay you dearly, for it. But do you take fixed rate or variable rate? I think more people are taking fixed rate debt now because of the fact that interest rates are rising and the gap is small. But if you're going to be exiting the business in 24 or 36 months, you could put yourself in a position where you have a prepayment penalty when you're looking to exit. So you're going to want to have a dialogue with your banker to make sure, what do your documents say? Make sure that there are no prepayment penalties if that's part of your plan, or negotiate, what that prepayment penalty, might look like.
Well, we hope we've given you some food for thought, and that you realize how important it is to get with your CPA and go through the multi-year planning and the multi-year projections. That'll help you maximize your cash flow and decrease your income tax liabilities. So Andy and I would both like to thank you for your time and attention, and I'll turn it back to Betsy to introduce our next speakers.